Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. One of the things that I like to do when I do these videos on stocks and bonds and finance and investing in general, especially value investing, because obviously as Mr. Valuation, that's where my true heart is. I like to also present stocks that simultaneously provide some lessons, some comprehensive understanding and perspectives of what true investing is all about. So today I'm going to cover what I call the money center banks, or the diversified banks, the big two, Bank of America and Citigroup. And there's a lot of reasons I'm covering these stocks, as I previously indicated. One is because they are quintessential example of the principle that earnings drive market price in the long run. And I think they really give that perspective quite clearly. So I'm going to cover those, and I'm going to look at them from a standpoint of a long-term view, but then I'm going to look at the last decade or so because, banks were certainly participants in the financial debacle that led to the Great Recession of 2008 and 2009. All right, and I'm going to show that and illustrate how that happened here when I go through this video. But I also want to talk about the idea that when you're looking at banks, you're looking at different animals than you are, for example, an industrial company. And that's something we're going to be featuring and showcasing in both the new version of FastGraphs, which we're hoping to launch on December 5th, as well as the FastGraphs Value U Academy, where we're going to be teaching finance with the help of two professors that are really renowned, that have written books and papers on value investing and also teach finance to executives throughout the world, frankly. So I hope you are looking forward to that as I am. But anyway, let's get into looking at these banks. But before I do, let's go ahead and turn to FastGraphs Value U Academy slide here. And I want to point out the difference between the income statements of a bank versus an industrial company. And that's something that is going to be very important, because when you're analyzing these things, you look at them differently than you would, an industrial company, for example, like a Johnson & Johnson. So with an industrial company, you have things like in the income statement, you have sales and revenue, and then you have cost of goods sold, and then you have gross and net profit margins, which I've been talking about. And then you have operating expenses. You have operating profit, which of course is EBIT, earnings before interest and taxes, which, divided by sales gives you operating margin. You also have other costs and expenses, profits before taxes, and then provision for taxes. Where in contrast, you look at the income statement of a bank, you don't have sales and revenues, you have total interest income. And then you have total interest expense, and that leads you to net interest income. Total interest income minus total interest expense gives you net interest income. Then you have loan loss provision percentages, net interest income after provisions, and then net interest income, and then non-interest expense, and so on and so forth. So as you can see, there are differences between these two financial statements. And I think that's, very important to have that perspective before I go through this presentation. But let's now move to FastGraphs, the fundamentals analyzer software tool. And let's start by looking at both of these big banks, Bank of America and Citigroup, from a long-term perspective, because as I pointed out in the beginning, earnings do drive market price in the long run. And that's why I'm always saying that measuring performance without simultaneously measuring valuation is a job half done. But valuation is a function of, it can be measured in things like price earnings ratios and earnings yields and cash flow yields and price to cash flows. You've got to also recognize that valuation and future earnings growth are joined at the hip. So you can have what look like low numbers and have collapsing operating results and have a company that's actually massively overvalued, even though statistically it looks fairly valued. But here's the point. Now let's look at Bank of America here first, and let's look at what was happening between the recession of 2001 and the Great Recession. We had incredible earnings growth during this time. So if I take the scroll bar here and bring it back into that time prior to the Great Recession, you could see that the Bank of America was growing earnings by over 12% a year. In contrast, if I move and go ahead and look at Citigroup, you'll see a very similar picture, but a different growth rate. I want you to notice the 7.84% growth rate. So while I'm on Citigroup, I'll go ahead and expand it out, and I want you to see the similarities between the two. You had pretty good operating results coming into the Great Recession, and then when the financial debacle hit, we had earnings collapse actually to go into massive negative earnings, over negative 756% earnings growth, from positive $7.20 to a loss of $47.20, followed by a loss of $8. And then once again, if I look at Bank of America, go back to it, you see really almost an identical picture, slightly different numbers, but you see very strong growth, a collapse in earnings. And then in both cases, note what's been happening over the last decade or so. So the point is, when I put weekly closing stock prices on this graph, the first thing I want you to see before I leave this is earnings drive market price. Stock prices are always volatile. This is fundamentally true in the long run. But there's the short run, which is the jagged stock price movements, the auction stock market. And emotions determine market price in the short run. That's why the stock price is always a very jagged, nervous-looking line, in contrast to earnings and things like earnings and dividends, which tend to be more, smooth or predictable or less erratic, if you will. But nevertheless, where earnings go, price goes. And when the earnings collapse, the stock price collapsed. And these were massive price collapses. Just so you put it into perspective, Bank of America from December of 06 to March of 09, it dropped 94% in value. In other words, it would have lost almost, all of your money. And that is very rare in the market, but it does happen. Now, once the financial debacle was over and all of the collateralized mortgage obligations and collateralized mortgage obligations squared and all the loose lending practices and so on that these financial institutions were engaging in, once that all kind of passed, if I look at more recent, post the Great Recession, if you will, these companies have started to get their mojo back again. And what I also want you to notice is they started paying dividends. Their dividend payout ratios were initially very, very low because at first, they eliminated the dividends, virtually totally, not completely, but they went from $2.24 down to 4 cents a share, which they only paid 4 cents a share for about 5 years. And then once again, the similarities between these companies engaging in the same business, if you will, and being the same or very, very similar. Citigroup did completely eliminate their dividend. Then they started paying a paltry 3 or 4 cents a share again. So, it's very, very similar characteristics for both of these companies, okay? Now, the question is, post the recession, once these guys kind of, took all the losses and reorganized their businesses and started performing as operating businesses again, and even started increasing their dividend payout ratios, you can see they went from 8.9% in 2016, this is Citigroup, to 18%, to 23%, and then more recently, 41%. We're starting to get back to more rational payout ratios. Bank of America simultaneously will look very, very similar in terms of the progression. Very low payout ratios, 16%, 15%. Then, they started paying out 20%, and then 38%, and they're getting up into that, 30 or 40% range. Now, let's also look at performance of these companies and see performance and valuation are so incredibly important. So let me start by going back to the historical graph, and let me draw it out here now, and I'll use Bank of America for this. Earnings grew, price grew, earnings collapsed, price collapsed, earnings started to grow again, and then they do have cyclicality, and the price clearly reacts to that cyclicality. This was obviously COVID, and we see that there is a long-term relationship between earnings growth and price. Now, long-term, these companies actually performed very poorly relative to the overall market over this long-term period of time. But now, if I shorten this time frame to kind of just coming out of the Great Recession, we start seeing performance that is at least compatible with the S&P 500. If I drop this again another year, we see that we're starting to get on par with the overall market. They're starting to perform in line, still slightly underperforming, but beginning to form in line. Now, if I do the same thing with Citigroup, go back to Citigroup, we're going to see a similar situation. We see, the fact that the company's performance came out, but at a different level. And this is what's important now. I want you to make a distinction between these two companies. So from here on in, the rest of this video, I'm going to focus on only since 2010, beginning of 2011, the end of 2010, etc., and look at these companies. Now, Citigroup has grown earnings at 7.38% It does offer a 3.08% dividend yield, has an earnings yield of 14.8% because the PE is only 6.7. But again, notice the erratic earnings that are going on here. Okay, so, the company's starting to look pretty good. It's BBB plus rated, et cetera. When I look at forecasting, I've got a 3% dividend yield. I've got earnings growth. If I look at a normal price earnings multiple of even only a mere 10 or 11 times earnings, I've got the potential to make more than double-digit returns on this company with a current 3% dividend yield. The question is, are you going to be able to trust that going forward? Bank of America, in contrast, compared to 7.38% growth, I've got 11% growth, almost double the growth rate. When I look at performance, as I mentioned earlier, I got much better performance, but this is where I want you to be careful. I've got a total difference in terms of valuation and growth. Here we're dealing with a blended PE of almost 14, 13.7 if you will. The dividend yield's only 1.85%, and that's partially because the valuation is almost twice as high as you would. Now, future growth is expected to be about 10.9% for Bank of America. Going back to Citigroup, looking at forecasting, it's only expected to be about half of that, or 5%. But the difference here is I've got a much higher potential for PE ratio expansion to give me a much higher rate of return in Citigroup with a 3% dividend yield than I do going to Bank of America, which has a higher potential growth rate, but it's probably closer to PE ratio, parity. The PE ratio wouldn't expect it to increase very much. So I got a much lower rate of return expectation with a much lower dividend yield. That's, the reality of these stocks. Both of these stocks look reasonably priced based on earnings growth here, but then I can also segregate them differently also when I look at revenues, or, as we call sales. Bank of America looks extremely overvalued based on interest revenue, if you will, or revenues. And in contrast, Citigroup looks actually a lot more attractively valued. Now notice that I've been changing this graph so that I can make adjustments so that the graph looks proper. Sales growth has been very low for Citigroup, but it has a much better valuation. So the bottom line is these are two very interesting companies that have really showcased the idea that when you're investing in the business, how the business performs is going to be a major determinant of how much money you make. If I was going to make an investment in either one of these, my choice would be Citigroup today over Bank of America, based primarily on valuation. I think Bank of America has better business prospects, according to what I'm seeing on fast graphs, than what I see with Citigroup, but the big difference is I've got to pay up for that. So I get a bargain with Citigroup. I get a better margin of safety. Both of these, companies are good quality. Bank of America is A- rated. Citigroup was BBB. There's a difference there. But the reality of it is I've got better value in Citigroup than I do Bank of America. So if I was looking at either one of these banks to purchase today, it would probably be Citigroup for my money. But on the other hand, I would much rather look at what I would call some of the smaller regional banks, as well as some of the Canadian banks, where I think I have better growth, better prospects, and less long-term abuse. Frankly, I didn't like what I saw happening here. I didn't like how this actually led to this great recession that we had. So, I did an article in a video years and years ago called Is It Time to Forgive the Banks? And I'm not sure I have yet, but that's up to you to decide for yourself. Anyway, this has been Chuck Carnevale showing you the two diversified banks, Citigroup and Bank of America. One, you've got a lot better value with a lot less growth. The other one, you've got still decent value with more growth, but you have less upside opportunity because you're buying that growth at full value. Those are the kinds of decisions that I think you need to make as an investor when you're looking at income. Citigroup has the higher dividend yield than Bank of America. So if you're looking for current income, Citigroup, again, would be the best choice, even though it's slightly lower quality, but it's BBB plus, one grade away from investment grade. Anyway, I hope you got something out of this. Hope you saw the clear relationship between earnings and market price, of how the business results really are going to affect you as a long-term shareholder. I hope you saw some of the different valuation opportunities that these companies provided. And I'll let you go ahead and do your own due diligence if you're interested in either one of them. Personally, I'm not at this stage, only because I think I have other financial service companies, including regional banks, as well as life insurance companies, et cetera, names like Prudential, et cetera, where I feel like I can, do better, have my money invested a little more securely, and so on and so forth. So anyway, this has been Chuck Harmel saying thanks for watching. If you like the video, give me a thumbs up, ring the bell, give me likes, join the channel if you haven't subscribed already. And you might want to take a close look at Fast Graphs. We're really looking forward to launching our new version, hopefully the first week of December. If all goes well, it's starting to look like it will, but it could be delayed a week. But the bottom line is we're getting very close to launching it, and we will be launching the Fast Graphs Value U Academy simultaneous to that. We may actually even launch some videos on the Value U Academy, some introductory videos this week. So I hope everybody has a great Thanksgiving holiday coming up. I want you to thanks for watching, and look forward to talking to you again real soon. Thanks.